Welcome to Zinvesting Podcast. I'm your host, Lauren Templeton. Let's start exploring. Welcome to the Zinvesting Podcast. I'm your host, Lauren Templeton, and I have a very special guest today, my husband, Scott Phillips. Scott and I work together at Templeton and Phillips Capital Management. He is a portfolio manager at the business, and we've worked together since 2006. Scott is the author, co-author of Investing the Templeton Way, a book that we wrote on our honeymoon back in, I believe, 2008, maybe, or 2009.
We were married in 2007.
No, when we published the book.
Oh, right.
And he is also the author of a book called Buying at the Point of Maximum Pessimism, and he's the co-author of a revised edition of the Templeton Touch. And that was a very interesting book where Scott went around the United States and interviewed money managers that had worked with my uncle, Sir John Templeton. So welcome, Scott, to the Zinvesting Podcast.
It's great to be here. Thanks for having me, Lauren.
So tell me a little bit about how you got started in investing and maybe about the first time you met my great uncle, Sir John Templeton.
Sure. So my path towards investing is not very different than yours. I was speaking to your father one day. We were still in college. You and I were dating. And he gave me, I guess, the conversation, so to speak. Well, what do you want to do with yourself? You know, what are you interested in? And I said, well, you know, I've given it a lot of thought, and I'm going to go to law school, and I'll probably practice law at some point. That's interesting to me. And he just kind of looked at me and said, well, that sounds pretty good, but I really think you should look at finance and investing. I said, oh, okay, that's, something I've never really thought about. And he said, well, look at it this way. If you go and work at a bank or an investment bank or a brokerage, you can do that for a year. You can learn everything that you can about money, investing, how it works. And if you don't like it, then go to law school, because there's just no way to opt out of the money game. So the knowledge you take away from that will be with you forever. I thought, well, that makes a lot of sense. And so that's exactly what I did. After college, I went and worked at a bank, and then relocated to Atlanta and was lucky enough to get hired at an investment bank in the research department of Robinson Humphrey, which is now known as Truist.
Yes, and then at some point you started working on some one-off projects for Sir John Templeton. So tell me about the first time you met Sir John.
Yeah, that was a very special day. I'll never forget that. So Sir John was in Winchester, Tennessee. He usually came and visited in the summer around some Templeton Foundation meetings, some informal gatherings, and almost like a family reunion. And I was lucky enough to be there visiting with you. And recall this on the back porch of your parents' house. Sir John was sitting there, and he had a number of people, seated around him. He was speaking, and everyone was listening. And then there was a break. And at this point, I was working as a young junior analyst at Robinson Humphrey. I was just learning everything I could about investing. I'd already, picked up a copy of Ben Graham's Security Analysis. I was just completely enthralled, and I was quickly grasping who he was in the industry and his stature and what he had accomplished. And this was like, the opportunity to go in the backyard and shoot hoops with Michael Jordan or something, to sit down and introduce yourself to John Templeton and talk investments was, both extremely exciting and extremely intimidating, as you can imagine. But so I had an opportunity. Everyone kind of got up and went and did something. So I sat down and introduced myself to Sir John. And he said, well, tell me what you do. And I told him I'd worked as an analyst in the research department of an investment bank. And he kind of leaned in. He said, oh, I'm an analyst too. And it just took me aback. It completely disarmed me. And, I was just so blown away by his ability to just kind of, break it down and break down those barriers that were there 30 seconds before. And we talked about a number of things going on in the market. Of course, this was, back in 2000. So we were at the height of the dot-com bubble. He was actively selling short tech stocks. And as we know now, he was on his way to making a great deal of money doing that. And what's interesting to me is, looking back on that, he asked me, what stocks we were following. And it was nothing like the tech stocks that were popular at the time. So we were covering consumer durables, we called it. So these were furniture stocks, floor covering stocks, things that were old economy and completely out of style. And no one was interested in these, but he was deeply interested in what I had to say. So we were talking about furniture stocks trading at 5 to 6 times earnings, floor covering stocks trading as low as 4 times earnings. Now, bear in mind, everyone in the market is chasing stocks trading at 100 times earnings. These were the hot stocks. That's where everyone was. He had no interest in that. He wanted to know about the bargains, which coincidentally, I knew a lot about at the time. And so from there, he said, this is great. I want you to send me your research going forward. We'll communicate and stay in touch. And I thought, wow, that's amazing. And so that's what I did. I would periodically send him research that we had produced on these cheap stocks that no one was paying attention to. And that's kind of how we developed a correspondence and eventually, a relationship as a research analyst and investor.
It's also interesting to me that he really did consider himself just an analyst. There he was. He had, such a legendary career, and he really saw himself as an analyst.
It's true. He did live the humble approach, just as he wrote. And I think that's what kept him grounded and kept him rational throughout all these different markets that he was able to spot the opportunities in. He always had a good center of gravity. He was a very objective person, a very rational person. And part of that is just believing that he was an analyst. He liked to look at stocks. He liked to invest in bargains. And it's important.
So what do you think made him such an exceptional investor? What were the personality traits that made him the investment legend that he was?
2 things stand out. I think the first is, of course, he was a very curious, intelligent person. Like, he read constantly. He wanted to learn new things. That type of mindset is kind of unusual, actually. Most people, when you see someone who's enormously successful, they kind of say, oh, I've made it. My work is done. And they kind of enjoy the fruits of their labor. And that's actually when they're kind of ripe for a fall. That's probably the last episode of their investment success. Let's just use investing as an example. But with him, he was continuously trying to learn new things, continuously trying to grow his knowledge and understanding of the markets. And that's a striking thing when most people in the world acknowledge you as one of the greatest investors in the world. He never lost that mindset. And so I think that's a huge piece of it. The other piece was he was just a deeply rational person. He was able to control his emotional faculties like no one I've ever really met. He always, was a careful decision maker. It was based on objective facts. And whenever he learned that he was wrong, he moved on. He did not get bogged down in a losing investment. He was on to the next one. And it was just that constant, methodical learning, adapting, scrapping what didn't work, going deeper into things that did work, that I think made him kind of a permanent fixture in the investment world for, 60 or 70 years.
Yeah, I agree with that. So every time we started a new strategy or tried something different, if it didn't work, he moved on very quickly, and he seemed to have no regrets over trying a new strategy or losing some money along the way in his experimentation of using different metrics or 100 yardsticks of measuring value, as he may say. He was a continual learner and read a lot. You also read a lot. Tell me what's on your nightstand right now.
Well, too many books. Obviously, I've got book ADHD. Unfortunately, I like to read, so I've got several that I'm kind of plodding my way through. But one that stands out that I think has really resonated with our own investment principles has been 100 to 1 in the stock market. That's a book that was written probably 30 or 40 years ago by an old research analyst and columnist. And that has just a ton of great wisdom, great investment principles, things that we practice, but have also reminded me to continue to practice. It's a good book. And then, of course, Red Notice, which is one of your personal favorites. I've picked that up. Deeply interesting, especially in the context of everything going on in the world right now with Russia and Ukraine. It reminds me of just how different countries and therefore investment environments can be, and how some of those differences are institutionalized. Because in a lot of ways, I think the lessons coming about in Red Notice were also present in We the Living, which Ayn Rand wrote. It was the first book she wrote, which was about her basic experience. A lot of people call it an autobiography, but it was basically detailing her experience of Bolshevik Russia before she left. And, some of the themes and the behaviors all seem consistent, which is fascinating.
Yes. Well, Red Notice is one of my favorite books by Bill Browder, and I've been trying to get Scott to read it for several years. And now with the Ukraine-Russia situation, I've encouraged him to pick it up again. And I've recently read a similar book called Red Roulette. It's about China, so that's also on his nightstand. But 100 to 1 in the stock market was a recommendation from Monish Pabrai, and he actually sent us a copy, I believe. And then we bought a copy as well.
Yeah.
And you've been raving about that book.
Yeah, it's great.
Since picking it up. Well, tell me, what are some of the most important lessons in 100 to 1 in the stock market?
Yeah, so one of the ones that I had already learned, but it deeply reinforced for me, was, and I'm going to paraphrase because he has a longer sentence framing this thought. But the paraphrase that I would use is that more money has been lost from selling stocks too early than buying the wrong ones. And that's kind of in the framework of Wall Street. And when I look at our own experience, it has certainly rung true. I mean, we've done, I think, some really smart and savvy things over the years, buying at the point of maximum pessimism, buying stocks during the great financial crisis of 08-09, bought aggressively, hand over fist during that period. And we got some great bargains, and we did well, but we sold too soon. We moved on to a different idea maybe a year or two later, when the fact of the matter is we could have stayed in any one of these stocks and done better. And so there's an important lesson in that, which is just when you buy the right companies at the right time, you really just need to sit tight. You need to be willing to hold it for 5, 10 years, even decades. And so, the big examples, that kind of come to mind were, I think at the time, 08-09, we had bought TJ Maxx, which did really well coming out through that. But, we were also kind of in an economic sluggish period, in the years that followed the great financial crisis. And the fundamentals of that business carried it much higher than after we sold it. I mean, I'm just throwing numbers out there. We doubled our money at least, but it went on and continued to double a few more times after that. And then a similar lesson came from buying the Mexican airport operators during the swine flu crisis. So that was also in 09, I believe the summer of 09. And there was a big panic around swine flu. This, of course, predates anything COVID-related, which is a whole different ball of wax, and we can talk about that too. But so the Mexican airport operators were spotlighted as kind of ground zero for the swine flu pandemic. I guess this was much smaller, of course, than COVID. But it set off a panic. So they closed the airports in Mexico. So immediately those stocks fell 20 to 25% in one single trading session. Of course, we saw the news. We looked at the fundamentals of the business. You're looking at companies that had 30% operating margins, no debt, good, low double-digit top-line growth. And they were trading at all-time lows in terms of their P's and all the other various metrics on cash flow and even book value. And so we bought 3 of them at the time on that day, and we eventually consolidated the positions into one position, which was ticker's ASR. My Spanish is horrible, so I won't try to destroy the name. But anyhow, we held it for, 1 to 2 years, something along those lines. But if we just held on for another 4, 5, 6 years, we would have done so much better. And the lesson there is that when you find a good company, there's so much to be gained from just turning it loose. Let the management exploit the growth opportunities. Hopefully, you've identified a company with a long growth runway, and the management can continue to reinvest into that growth runway. And that's how you get capital compounding on top of itself. And as an investor, your work is basically done. You just monitor it. You make sure that the process is still being followed. You make sure that the management team has not imposed some level of agency risk, that they're being honest, that they're returning capital to shareholders in the way that you believe they should. And there's so much tax efficiency in that. There's just, that to me was one of the big lessons that was reinforced in 100 to 1. Because 100 to 1, he talks about stocks that go up 100 times, which for a lot of people is somewhat unfathomable. But when you find the right companies and buy them at the right time, usually it's during a panic or a bear market or some other very difficult circumstances or scare, and hold on to them, they can do that. And once you realize that, then you recognize that you're really wasting your time trying to time your way in and out of other stocks, trying to make double your money here or there, that you're going to make mistakes and they will pile up over time, and the opportunity cost of what you lost far exceeds any of these kind of clever moves you may make being a more active investor. So part of what we do is really being extremely aggressive as an active investor at the right time, buying the right stocks, and then really being more passive from there, letting the capital compound.
Yeah, it's
That's
interesting. When people come into our office, I think they expect to see just a ton of activity. Right. And we do have very, very active days, but they're few and far between. They're really at the times of maximum pessimism or major market sell-offs when there's a lot of volatility. Otherwise, our office is kind of like a library. There's a lot of reading and downloading of information and sorting through information. So it's kind of a quiet place to work. You had an interesting anecdote you shared with me yesterday about the Templeton Growth Fund and Sir John leaving stocks in that portfolio for decades. And one of the portfolio managers, Mark Halawesko, had taken over the Templeton Growth Fund and his perception when he saw that.
Yeah. So it's deeply insightful. It's the same lesson I just shared, really, but it really works. And, when we wrote Investing the Templeton Way, we profile a number of trades and smart moves that Sir John did, and there are common threads in there that are the important lessons for investors to take away. But it's lost on a lot of people that he had such control over his emotions. And once he found something that worked, he had the ability to stick with it. And so it was the same lesson, that if he found a company that was growing and he got it at a good price and it was going to continue to earn money for him and compound returns, he left it alone. And this was, the story from Mark Halawesko is when he took over the Templeton Growth Fund around 1987 or 88, somewhere in there. And when he looked in the portfolio, he saw stocks that had compounded, 10, 50,000% total returns because Sir John had just left them in there for 30, 40, 50 years. And it's so important for investors to realize that. Even if you're just a passive investor dealing with indexes, do not overlook the gift of compound interest at 8 to 10% per year. And the lesson is, don't try to time your way in and out of the market. You got to let the money sit there and accumulate. That's how you build wealth, not trading in and out of stocks.
Well, I assume that all of our listeners know what you're talking about when you say maximum pessimism. But just to be sure, could you please review the theory of maximum pessimism as defined by Sir John Templeton, and it's the philosophy that we use at our company as well. So would you please describe that?
Sure. So it definitely comes, it manifests itself through different market events. The beauty of the stock markets is that it's not always rational, that there are emotions involved. So maximum pessimism and trying to exploit those opportunities occurs when essentially people get scared or fearful, and it sets off a process where you eventually, from a market standpoint, you can exploit a scenario of forced selling, which is, when you get into a bull market and things turn the other way, there's a great chance that people in the market have been using leverage. And so when that process reverses and investors or speculators in the market begin to experience margin calls, they're being forced out of these stocks that they would otherwise not sell. That's when the best opportunities appear. That's when you get to take advantage of irrational pricing. And the way you see that, well, there are a number of ways, but really it comes down to exploiting the lowest P's you've ever seen in a particular stock or a particular market, the lowest price to cash flow multiples, the lowest price to book ratios, the highest dividend yields. They can manifest themselves anywhere, but that's how you get a bargain. And that's how you get exceptional returns in the stock market. You have to be willing to exploit these gaps, these errors in judgment, or the situations where people have no choice but to sell. And you'd be surprised at how often these events come along. March 2020 was a great opportunity. We were buying stocks then like we had not since the crisis of 08-09. It was an exciting time, for sure. And they were great opportunities.
It was a scary time, too. I remember in our office, I was nervous and thought I had a fever, and you didn't feel well, and we were guessing whether or not we had COVID. We probably didn't, but we were in there buying stocks, and really helped our returns.
Absolutely.
What I was hoping you would say, though, was the famous quote by John Templeton, which is, "Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell." So I think that one quote really tells our listeners what his strategy was and what our strategy is at Templeton and Phillips Capital Management. Can you tell me a little bit about your investment process and how you go about finding opportunities?
Yeah. So it really, of course, you try to refine and improve it over time, but it goes back to the first lessons from John Templeton, which were start on a quantitative basis. Let the numbers show you where the opportunities are. So, of course, we have rankings where we use valuation metrics. And on those rankings, we combine those valuation metrics with the operating fundamental ratios of the company, how profitable they are, their returns on invested capital, their growth rate on the top line, their vantage point towards returning shareholder capital, whether that's through dividend increases or share repurchases. There are all kinds of ways to look at this. But what you're looking for is a near-term or short-term phenomenon in the share price that is completely at odds with the longer-term fundamentals of the business. Those are the gaps that you're trying to exploit. And there are any number of ways to look at that. But that is the starting point for what we do. We're looking for those discrepancies, those discounts, those bargains. And then from there, we dig into the fundamentals of the business. We look to see basically whether the market is right or we think it's wrong. We think it's temporarily pessimistic, or it has a real reason to justify its dour outlook. And so from there, it's really just a matter of understanding the business, understanding the challenges that it's confronted with, whether these challenges or difficulties will be worked out within the next year, couple of years, 5 years, or it's facing a true threat to its operating, its business model, whether there's a threat of obsolescence or new competitors come in. So you have to be discerning for sure. And those judgments get a lot easier when the entire market goes on sale. So that's the kind of maximum pessimism effect. That's why we're just so aggressive during those periods. And in those periods, we're really indulging what we call our wish list, which also came from Sir John. So you mentioned the library atmosphere. We spend a lot of our time studying businesses that are successful and the durability of their growth rate. Where are their long-term opportunities? Can they sustain themselves? Can they reinvest? Can they fund their growth? Are there competitive threats? And so those are the things we study on a regular basis, so we know our next move when the next crisis or panic comes along. We know what we want to buy. We just wait. And so a great example, there's several, but a good recent example was Amazon. So, Amazon has been kind of a lightning rod for value investors. You either see that as a value play or not. But there were value investors who saw it a lot earlier than others. And so I remember we were speaking at a conference in Munich, and we had met Bill Miller's protege, Sam McLemore, and she was talking about Amazon and the opportunity in there. And I was thinking, this is 5 or 6 years ago. I don't remember how long. I was thinking, that's so odd that you would call that value. But then I heard a little bit about what they thought, and I could see the accounting effects of the continuous reinvestment and how the cash flows were playing out and funding all these new activities. And I thought, I see, that's clever, that's ingenious. And I saw what the market was valuing. But at that point, I did not think it was a bargain. We didn't think that was a bargain at the place it was trading. Fast forward to March of 2020, 5 years later, and within a month's time, probably less than that, 3 weeks, it traded down to a price to cash flow level lower than where it was in 2008, 2009. That was a bargain. That's when we bought the position. That's when we made it a large position across our portfolios. And so a lot of this is just the mental discipline to wait, to be patient. I mean, it's all about patience. Sir John said that. Charlie Munger says that. It's true. It's about patience, waiting for the opportunity and then being able to sit in the stock and let it just do its job.
Well, you have a great memory because I had forgotten all about that conference in Munich. I think I was pretty sick on that trip, had a bad cold or something like that. But it does bring me to my next question, because one of the other people that we met at that conference was James Montier. And as you know, I'm a great fan of all of his books. He's written extensively about behavioral finance, and has several books on the subject. They are endlessly fascinating for me. I continually am drawn back to these books. So what do you think your edge is as an investor?
Behavioral. There's no question about it. Again, and that's what I saw in Sir John time and time again. I mean, he had all of the intellectual faculties and the passion, and he was smart, and he'd seen so much. But at the end of the day, when you distill it down to investment success, those are important factors if you're trying to be the best investor in the world. But most investors just want to beat the market, or at least match the market. And if you want to do that, these are things that anybody can do. It's not predetermined by your knowledge of financials or the markets. It's just a matter of having control over your emotions and doing the right thing. And the right thing to do is to buy stocks when they get cheap and hold them. Do not try to time your way in and out.
So do you think you're naturally good at this, or is this something that you've acquired over the years? How should our listeners think about controlling their emotions? Is it something they can learn?
I'm not so sure you can override the physiology of that. So it's controlled by this little almond-shaped piece of your brain called the amygdala, which controls the fight or flight response in most humans. I think in my case, I tend to fight more than flight. Whether that's good or bad is debatable. However, in the markets, I think it's generally the right response. Nevertheless, if the markets scare you or volatility scares you, there are absolutely measures you can take to override those responses. You can have good to cancel limit orders in the market that would trigger the purchase of a stock if it suddenly fell 20 or 30%. Sir John did that. A lot of it is just having a plan in place, having your wish list, knowing what you want to do when the sales appear, when the bargains are there. And, the other thing, and we've talked about this in previous talks and interviews, is that if the market is stressing you out, get up and walk away. Turn off the computer, go for a walk, go do something else. What you don't want to do is cave into the impulse of fear and sell at the bottom, And so that's what's most important. It's kind of understanding yourself and taking the measures, right, to compensate for that. So for me, I think that luckily I was able to start from the vantage point of, I want bargains. I want to buy things when they're cheap. That's either ingrained in you or not. Like, you're either the type of person who likes to go into a thrift shop or wait for a sale or buy things secondhand or whatever. It's kind of a game, honestly. I think you're either wired that way or you're not. If you are, you've got a good chance of just seeing the market for what it is, which is a compounding machine that goes on sale occasionally.
I do think you're really good about controlling your emotions, and you're a very disciplined person like John Templeton. So your day is very organized and you're very methodical about your exercise routine, and you've been meditating for years, and you have your time you set aside for reading, and you're just very disciplined in the way you've organized your day. Can you talk about the way you've organized your day and the way other managers have done that? I know you don't like this question. I see that you're rolling your eyes at me.
No, I think that the important thing is to develop routines that are constructive over time. And Sir John certainly did that. He had a steadfast routine of every morning around 10:30, mid-morning, he would get up, walk out of the office, and walk on the beach in the surf of Life Key every day for an hour. It was his exercise routine. He believed in that. He believed in the benefits of that mentally. I share the same view. I think it's really the only way I can keep my head on straight is to infuse a good exercise routine in my day. So for me, that it's a totally different thing. It's 5 to 5:30 in the morning. Riding the Peloton, running if the weather's nice, doing push-ups, doing planks, things like that. And I find that it gives me a great degree of calmness in my mind. It just helps calm the tension, helps my focus. And then, over time, you also kind of learn that diet plays a role in that too. So you try to eat healthier things that aren't going to give you kind of the big physiological effects of, like sugar that's going to take you way up and then crash you down, or too many carbs, or things of that nature. And you just kind of tinker and refine over time, but it bakes itself into your daily routine. And all of it is just geared towards a better outcome, a better mental outcome, better psychological outcome. But yeah, I think that, and I think this is catching on more today, this idea of wellness and what it takes to keep your head screwed on straight at all times. And a lot of it has to do with just taking care of yourself in the less obvious places, whether it's exercise or diet. It all feeds into each other, all of it, even into decision-making and in your mental faculties.
And do you meditate? I mean, I think you have been meditating, right?
I do, yeah. I mean, again, it's just a matter of maintaining focus, maintaining, the ability to kind of declutter your mind. One of the things that's fascinating about the markets today versus, when we started out almost 30 years ago, it's hard to believe it's been that long. Back then, people were seeking information. Information was kind of the lifeblood. You wanted better information. That's how you would get an edge. Today, it's completely opposite. You are absolutely inundated with information. There's too much to even process. And so you have to have the ability to parse through the quality of that information and not be distracted by, tantalizing headlines or things that don't matter. And that takes a lot of mental discipline too, to maintain that focus. You've just got to be able to zero in on what matters. And that's it's a constant effort. And so things like meditation help that, for sure. No question.
Great. Well, we continue to read about the resurgence in value investing. It's been some hard years for us value investors. I love Tom Russo, as he says, to be a value investor, you have the capacity for pain. And that makes sense on a number of fronts. Just to be a value investor and step into these positions, you need the capacity to suffer. Right? And then as value investors, we've had a really long stretch of underperformance versus growth. So we've also needed the capacity to suffer through that. Can you tell me your thoughts on the resurgence of value investing, and what do you think about this current environment? Will value continue to outperform?
I think so. I think that on some level, the value versus growth narrative is a little bit false. It really that buys into this idea that value investors only traffic in stocks that don't grow, or cigar butts, or things of that nature, that they only invest on an NAV basis. And I think one of the most important lessons from Sir John was having this varied approach to spotting a bargain. It's not just a low PE. There's so many metrics you can look at, and you need to understand those metrics in the context of the market we're in. So, if you look back over the last 10 years, which has really been described as this growth-friendly market, that's true. But, there have been bargains along the way. It just relies on your ability to see them and go against the consensus. So a great example was late 2014. We were going through our screens in the office, our quantitative screens, looking for bargains in the market. This is late 14. And I was going through an enterprise to EBITDA multiple screen. And I was culling through all the numbers. There are probably 500 or 600 stocks on this list. And I'm drilling down into the bottom quartile. These are valuations that are less than the S&P 500. So it's a discount to the market. There should be an opportunity in there. And I see this name on there. And I kind of did a double take. I rubbed my eyes and said, does that say Google? I looked at it again and I said, my word, what is this doing here? It was trading at 9.5 times EBITDA. And I was so baffled by it because this had been kind of the perennial growth stock, the one that all the growth investors had piled into and done so well up to this point. Because, it had been in the market for 14 years. It kind of came out of the dot-com. It IPO'd a few years later, but it had done extremely well, traded at huge valuations. So I saw this and I thought, I don't think these metrics are right. I think there's something wrong in the numbers I'm looking at. So I went into the financials, verified the numbers. It was correct. And so, again, that's the type of anomaly I mentioned earlier. What is this doing here? So it just starts another series of questions. And what had basically happened was it had kind of fallen out of favor with the growth investing crowd. Facebook had just IPO'd. There were lots of stories that Facebook's ad revenue was challenging Google's, that Google's ad algorithm had broken down. They were falling, to competitive factors, that its growth rate was slowing. So this whole crowd of growth investors dumped it. And that's how it ended up in the bottom quartile of the market. And so from there, we looked at it and said, well, what are the fundamentals going forward? What is the worst case scenario? And none of the analysts or industry experts thought that growth would be much lower than 20% going forward. And so that to us was a bargain. That was an opportunity. It did not fit the category of value, quote unquote. This was a company that was growing pretty fast, that did everything digitally. There were no hard assets. There were no factories. You could not compute, an NAV style analysis to value it. You had to value cash flows. And you had to understand that they were making all these investments and that was dragging down the operating margin at the time. It wasn't a loss of competitive edge. It was all of these unreported, unconsolidated businesses. The investments into YouTube, the investments in the Nest. And you had to just think, well, I think these businesses are growing. I think this is an opportunity and people are missing something here. And I remember when we bought it, we almost had to apologize in some way because they're like, you don't buy these types of stocks. What are you doing here?
We justified it to our investors.
We had to.
Don't be scared when you see this in the portfolio.
Right. And, as it turns out, and this is just pure luck, but I think you make your own luck. Later that year, actually, this is in 2015, fall of 2015, Google made an announcement they were reorganizing into Alphabet. And they kind of peeled back the curtains and showed people what was really going on, gave more evidence that there were a lot of investments into these new businesses. So that was depressing the operating margin, and that their growth algorithm on ads was still very much intact and had room to go. And it was a catalyst. And that's a stock that we've literally held ever since. Like, it is still in our portfolios. And that's what I mean by buy right and sit tight. Make your decision. Buy the bargain. If you won't get them all right, but some of them will be. But then sit. Just be patient. Just watch it.
So are you seeing any interesting anomalies in this market? Where are you looking for opportunities?
Yeah, there's no question that the most attractive opportunities from at least from a perception basis on valuation are all outside of the U.S. So the U.S. Markets, I wouldn't say at this point they're unattractive or too expensive, but the bargains, the apparent bargains in places like Europe or the emerging markets or pieces of Asia, India, they're just much better. They're very depressed. What's important to recognize.
Well, India had a great year last year.
They did. So. They did. And again, we've owned stuff there for 12 years. So it's all just kind of relative, I guess. But but the thing is, what's important to recognize about the U.S. and its premium to those other markets, and in the international markets, the response to COVID and the damage done to those economies from COVID was much greater. So you've kind of seen this, we had the self-imposed lockdowns, the brief recession, and then a recovery. Well, that recovery is still basically ongoing in these other markets where you have all these depressed multiples. And so to me, there are still great companies in these markets trading at depressed values, values that, on a PE basis or a dividend yield or price to cash flow match their largest discounts since the great financial crisis. Very appealing. And you can find good track records. You have to be a little bit careful, when you need to discern some things on the fundamentals. Like, you don't want to buy the so-called value traps, obviously. But I think they're well-run companies trading at attractive discounts, and you just kind of need the nerve to step in. And, of course, with all of the geopolitical tumult, including Russia and Ukraine, people are more scared to invest in those markets. So the bargains are there, we think. And so that's where we've been active.
Scott, would John Templeton be looking at Russia right now?
I don't think so. And the reason being is it really kind of goes back to what we were saying about agency risk. And we talked about it in the context of a business manager and whether they're taking care of their shareholders or whether they're, basically running up too many stock options and, sterilizing those with their cash flows, not reinvesting in the business, not raising their dividends. But there's a more important kind of institutional backdrop when it comes to property rights, and that's how you're treated as an investor. What are your rights? We're talking about the assets of the business. Who controls those? Do the shareholders control it? Does the management control it? Or does Vladimir Putin and his oligarchs control it? Who's looking out for you as a shareholder? And that, to me, that's been a problem that we've had, with the prospects of investing in Russia for more than 10 years. It's just a matter of how protected am I? What is my recourse if there's some type of malfeasance? And I think the unfortunate answer is you can get wiped out at any moment and no one's going to care. If the CEO of your business looks at Vladimir Putin's girlfriend the wrong way, that guy will get thrown in jail, and then what? It's you really don't have any shareholders' rights, and I think that's important.
So does the same logic transfer over to China?
That fear has become more prevalent, and that is actually why this is another stock example. So we bought Alibaba. It was also in 2015. They IPO'd, I think, at the end of 14. Stock went down 55%. It was overpriced. You had the Ben Bernanke taper tantrum. So emerging markets came under enormous pressure. Stock got, pretty cheap, we thought. And so we bought some then, very low multiples, I think 19 times earnings at the time. And that was another one we had to go to our investors and say, look, no, I promise, we're not growth investors. This is actually, a bargain. This is value. And we held that all the way through May 2020. What really spooked us in May 2020 was not the valuation. It was just all the back and forth on the geopolitical front and the understanding that we held an ADR that really just gave rights to a variable interest entity that didn't own anything. So we didn't have the shareholder rights we would like. Now, we could turn around at any moment and buy the shares in Hong Kong and kind of, I think, alleviate a number of those concerns. But the events that have transpired since, I think, lays it bare, which is, at least in this current regime, you have to have a form of patronage, I think, on some level, or at least not rattle members of the Communist Party, because they can step in at any moment and take control. I think that's what's really rattled shareholders in the tech stocks like Alibaba, which is now trading at 8 to 9 times earnings, I think, or at least before this recent bounce. And so, I think if you're a really long-term shareholder, those ideas make sense, but you need to be able to stick it out through, years. Because I do think that China has to have a market orientation over time to continue advancing, prospering, developing, and but it ebbs and flows in a country like China, and right now it has certainly been ebbing. But that's where the potential bargains appear.
Well, I have a few more questions before we wrap up. Charlie Munger has famously invested in Alibaba.
Correct.
We're on our way to the Berkshire Hathaway AGM in about a month, and we're going to take both of our children with us. Our oldest daughter has been twice, but the youngest daughter hasn't been at all. Can you talk to our listeners about the Berkshire Hathaway event and just what you get from going to the annual meeting?
Oh, sure.
Get out of going to the annual meeting?
No, for me, and I think you share the view, like, where else on earth can I go and find 40,000 people who think exactly the same way I do? It's like the perfect getaway. No, there's so much to learn when you go to those events. The fact that Warren Buffett and Charlie Munger offer their time and have for so long. There's just so much to pick up and gain from listening to them and their wisdom on business and investing. And then, all of the events surrounding Berkshire Hathaway are worthy. I don't want to call them sideshows, but definitely things where you can gain a lot of knowledge and insight and networking and resources and sharing ideas. It's really a great experience. If you are trying to learn more about investing, that's a great place to start.
You might want to share that Berkshire Hathaway is a huge holding in our portfolio. I think about 13% now.
That's true. It is. We've held it for a while. It got, we think unjustifiably discounted about a year and a half ago. And of course, you've got this kind of implicit, or it has been explicit actually in the past, that the management will step in and repurchase shares. I think that the old benchmark was if it falls, below 1.25 book value, that they will be actively repurchasing shares. So you get, a lot of kind of guarantees. I think not guarantees that they're going to make you money, but implicit guarantees that they're going to look out for your interests as a shareholder. They own so much personally. They're going to treat you in a way that I think on average is much better than a lot of the companies in the U.S. And people have continuously kind of written it off or bet against it, and that's been a bad bet for a really long time.
It's always interesting when the markets are hot and people start talking about how Warren Buffett's lost his touch. It's typically a good sign that the market's about to.
It's so true. We've seen a
change.
couple of these cycles in the last 20 years, and yeah, it's been true every time.
Well, Scott, what's one thing that you wish investors understood about you that you think they don't? That you have a beautiful wife.
Well, that's 100% true, but I think people understand that part. You are a remarkable person, and I'm very fortunate to work with you and to be married to you, of course. No, I think that, what I would say is what I found to be successful in investing over time is replicable. And again, it goes back to not being a genius, even just having just kind of reasonable levels of intelligence and an interest in investing. If you have the right behaviors in place, you can be a successful investor, and the market can be something that works for you and doesn't, work you over time, which I think most people unfortunately have that experience.
Well, another hard question. I want to close with some humor. What is your favorite memory or story about John Templeton that you could leave with everyone?
Sure. Yeah. So this was a really neat story.
So you have one.
I do. So this goes back to I want to say 2004. So it was the summer of 2004, if memory serves. And I was working in the Bahamas for a hedge fund there, and I was interacting with Sir John a lot, doing some research for him. He would just, send me little research projects, and I would pitch in and work on those. And it was his, annual summer trip back to Winchester. And
this is a good story.
Yeah, his assistant, Mary Walker, was kind enough to point out to Sir John that I was in the Bahamas and might like a trip back to Tennessee to visit with you, Lauren. And so he invited me to accompany him on his friend's private jet, which was the CEO of Motorola. And it was this big kind of Gulfstream, I don't know the model, but, let's just call it a Gulfstream 2. Big, private jet. And as the circumstances were, it could not land in Winchester. It was too big. So it had to land in Tullahoma, Tennessee, which is a little bit bigger than Winchester. Not a big city, but
longer runway.
Yeah, longer runway. They had a Red Lobster. So there were more people in Tullahoma. It's bigger kind of Middle Tennessee metropolis. And So we get on this flight, have a lot of interesting conversation. Of course, I'm just, lapdog. I'm, again, shooting baskets with Michael Jordan, just hanging on every word.
And you said the interior of the plane was very 1970s, right?
80s. But
80s.
Yeah, like orange. Well, 70s, 80s. It was kind of this orange-brown vibe with some shag carpet, but a really, cool jet, big. And at the time would have been, extremely fancy. Nevertheless, we end up landing in Tullahoma, and this is, of course, I think June, if that's right. And coincidentally, what's near Tullahoma is Manchester, Tennessee. Manchester, Tennessee, as most music fanatics know, is the home of Bonnaroo. And all these famous bands come in the summer and play at Bonnaroo. And this happened to overlap with the same weekend that we were coming into Tullahoma in this big Gulfstream jet. And so this jet lands on the runway in Tullahoma, and the pilot gets up and puts the door down, and Sir John starts out, and we see all these flashes coming up through the entryway, the door, and Sir John just throws his arms wide open, to greet all of these people, and so there were probably 12, 15 reporters and photographers at the foot of the stairs snapping pictures, and heard one of them kind of say, "Hey, I don't think this is the Black Crowes or Black Eyed Peas or whomever it was." You get the idea. And so they clearly thought that we were one of these rock bands coming into Tullahoma on the Gulfstream, ready to play Bonnaroo. But it was just kind of one of those funny anecdotes, and and Sir John got to the bottom of the stairs, and a few reporters interviewed him and gave him the article in the local newspaper. So it was really neat. That was kind of a fun story.
That is from way back. Story, and I always enjoyed his trips home in June of every year. He would come, and we would usually have the Templeton Foundation meetings there. The Templeton Foundation meetings started on the back porch of a home in Monteagle, Tennessee. And as a child, I can remember sitting on that back porch for the initial meetings when all the parents were discussing the Templeton Foundation. It was always a treat to have him come home to his hometown and visit with my grandfather. And it was really sweet to see the two of them together. I think he really enjoyed his visits there and always got a chuckle. He would go to the barber shop and ask the barber about, who's that guy, John Templeton, the road's named after, and listen to the guy's response. So he had a sense of humor.
Yeah, no, your father shared a story that he would go into the local, Sir John would, when he was on this visit. I think one time he went into the local
brokerage firm.
Yeah, Raymond James' office, and asked the broker if he had any, stock tips.
Yeah, that's really good, really cute, and I appreciate you spending time with us today.
My pleasure.
It's been a pleasure, and maybe we can grab some lunch after this.
Sounds great.
Thank you for listening to the Zinvesting podcast. I hope you enjoyed the show. If you have any questions or comments, please visit our website at zinvestingpodcast.com. Happy investing and stay zen. As you know, investing is inherently risky. You can lose a lot of money. Past performance is not indicative of future results. Nothing in this podcast should be construed as a recommendation to buy or sell any particular security or invest in any particular sector, industry, or country. Do your own homework and be careful out there.